Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. Here is Laurie Bailey with EURUSD currency pair forecast. Let's have a look. At yesterday's meeting, the European Central Bank lowered its key interest rates by the expected 0.25%. In its accompanying statement, the central bank emphasized its commitment to a restrictive policy, which has led the markets to strengthen expectations for another rate cut in March and to anticipate a total of 3 cuts by the end of the year. However, the euro did not decline significantly, dropping only 30 pips. Primarily due to weak GDP data. In the fourth quarter, GDP showed zero growth compared to an expected increase of 0.1%, while the annual GDP remained at 0.9%, falling short of the anticipated 1% growth. It is important to note that GDP has unique characteristics compared to other indices. It often accumulates alongside subsequent weak data and can have a delayed effect that extends over a week. Next week, key inflation data, PMI reports, and a broad range of U.S. economic indicators, including unemployment figures, will be released for the Eurozone. However, the euro approaches these events from a notably weak position. A consolidation below 1.0350 support level could open the door for a decline toward the 1.0135. On the 4-hour chart, the euro consolidated below the balance and indicator lines, after making a false breakout above them and reversing from the 1.0458 level. The Marlin oscillator has turned down from the zero line. Currently, the price is consolidating above the 1.0350 while aiming for a breakout. And now it's time for GBPUSD. Let's discuss it with Paulo Greco. The average volatility of the GBPUSD pair of the last 5 trading days is 91 pips. For the pound-dollar pair, this value is considered as average. Therefore, on Friday, January 31, we expect movement within the range limited by the levels of 1.2367 and 1.2549. The higher linear regression channel remains directed downward, signaling a bearish trend. The CCI indicator entered the overbought area and formed a bearish divergence. A resumption of the downtrend is expected. We do not recommend taking long positions at this time, as we believe that all factors supporting the British currency have already been factored in the market multiple times, and there are no new catalysts for growth. If you trade on pure technical analysis, long positions could be considered if the price rises above the moving average line. It's a sign line on a graphic, targeting levels at 1.2512 and 1.2549. However, sell orders are still more relevant now, with targets set at 1.2207 and 1.2146. But now a firm consolidation below the moving average line is required. That's all for today. Wish you best of luck.